Hello again. I think that most everyone by now has heard that the CFTC has recently passed new regulations that, among other things, are going to limit the amount of leverage that's available to retail Forex traders. Now, when you first heard about this, didn't you hear everyone saying this is the death of the Forex trading industry and the government is trying to shut down Forex trading? Well, I would like to suggest to you that if you actually develop the skill of entering and exiting trades with consistent profit a high percentage of the time, and if you have patience and discipline and good money management, you're going to achieve any financial goals that you set out to achieve, regardless of what leverage is available to you. And if you don't possess this skill, it doesn't matter what leverage is available. It won't make any difference because you're just going to lose your account anyway. So let's take a look at exactly how this is going to affect your business.
Well, it's very important for Forex traders to understand how leverage works so that you'll know whether 50-to-1 leverage is actually going to make or break your business. And it's a good idea to know how to trade Forex with 50-to-1 leverage. On August 30th, 2010, the CFTC issued final rules which limit the leverage available to retail Forex traders to 50-to-1 on major pairs and 20-to-1 on all others. These rules are effective as of October 18th, 2010. Well, if one standard lot is $100,000, at 100-to-1 leverage, a trader will deposit $1,000 from her account while a trade is open. So that amount is simply taken out of the capital of the account and held temporarily while the trade is open. That amount is simply held by the broker as a deposit until the trade is closed. In a 50-to-1 account, the trader will deposit $2,000 when entering a trade of one standard lot. With a standard lot of $100,000, the value of one pip for most major pairs is $10. So a 100 pip gain or loss would result in a gain or loss of $1,000. Since it's virtually impossible for a trader to lose the amount of the actual value of a lot, $100,000 in one trade with one lot traded, and since brokers automatically close a position that gets close to using all the margin available, leverage and margin trading benefits both brokers and traders. Because of the automatic margin call, it's not possible for a trader's account to go into a negative balance. Therefore, the maximum amount of capital a trader can have at risk is the amount of capital in the account. But of course, traders who understand proper risk management will also typically not risk more than 2 to 5% of the capital in the account, even with high leverage available. So the best consumer protection is not forced regulation, it's training and education. Traders who put their accounts at risk should at least understand how this works before trading. So let's look at an example of how this would work side by side with a 100-to-1 leverage account versus a 50-to-1 leverage account. So let's say you're going to try this out, and this would be with a $50,000 account size. As an example, there's no rule that you'd have to have $50,000 account to trade a standard lot, but in order to not exceed your 2% maximum capital at risk, it'd be a good idea to have somewhere in that neighborhood. The value of a pip in this account would be $10, and that would be the same in both accounts. 2% of your capital at risk would be $1,000, and that would be the same in both accounts. With a 25 pip stop loss, that would enable you to trade 4 lots and still not exceed your 2% capital at risk of $1,000. Because with a 25 pip stop loss and a pip value of $10, that's $250 at risk per lot traded. Well, a 50 pip winning trade with those 4 lots would result in a gain of $2,000, and that would be the same for both of those accounts. So the amount that you have at risk and the amount that you would gain from a given trade would be the same in both accounts. Here's where it would get different. The deposit to trade those 4 lots in the 100-to-1 leverage account would be $4,000. In the 50 to 1 leverage account, the deposit would be $8,000. So the amount of your capital remaining in the account, the amount of margin remaining, would be $46,000 in the 100 to 1 leverage account, and it would be $42,000 in the 50 to 1 leverage account. And of course that deposit is only subtracted from your available margin during the time that the trade is open. Well, what about a mini lot size account example? Because in Forex trading, a lot of people like to start with much smaller amounts of capital. For a mini lot size account, you might be able to get away with as low as $2,000 and start trading with acceptable risk management. Let's say in this example that you have an account size of $5,000. The value of a pip is now $1, and that's the same in both accounts. 2% of your capital at risk would be $100. That would be the same for both accounts. With a 25 pip stop loss, that would enable you to trade 4 lots in both accounts. And again, with a 50 pip winning trade, as an example, with those 4 lots, you would have a gain of $200, and that would be the same for both accounts. And where it gets different is that the deposit for those 4 lots would be $400 in the 100 to 1 leverage account, and the deposit for those 4 lots would be $800 in the 50 to 1 leverage account. And your remaining margin in the 100 to 1 leverage account would be $4,600, while in the 50 to 1 leverage account your remaining margin would be $4,200. Now, does this really make or break your business? Not at all. If you're using proper risk management, it's going to make absolutely no difference at all. So what's the problem with high leverage? The only problem with high leverage is if uneducated traders use poor risk management, because we're never going to have the entire account leveraged at 100 to 1. With proper risk management, 100 to 1 leverage is never a problem, but it's also not really needed because it's never actually used. We never actually leverage our entire accounts with 100 to 1 leverage. So the bottom line, the most important thing remains that you need to find out what works in Forex trading. Forex trading remains one of the most potentially lucrative businesses available in the world, with one of the lowest possible startup costs compared with most other businesses. And if there's global economic crisis, it doesn't necessarily reduce the opportunity in Forex trading. In fact, during recent global economic crisis, we saw that our opportunities remain the same or perhaps increase. Forex trading is a home-based business that can be done from anywhere in the world that has internet access. So, in my opinion, Forex trading remains one of the most ideal businesses that is possible to do. Among any possible business you could ever think of, Forex trading really is one of the best, in my opinion. So if you're just starting to get interested in Forex trading, or if you've been involved in Forex trading for a while and you've taken other training programs and you've struggled and just not getting the results that you're looking for, if you're interested in finding out what's really working for professional traders who earn their income from Forex trading, go to forextradingseminar.com.